Welcome to The Explainer. Every day in the financial markets, you are faced with a choice. Are you acting as an investor, carefully building long-term wealth, or are you behaving like a speculator, simply placing a bet? Making the wrong choice can have truly disastrous consequences. So in this explainer, we will provide the framework you need to understand the difference.
Mark Twain's wit perfectly captures the inherent danger of speculation. It is a hazardous game, whether you have very little to lose or, perhaps especially, when you have a great deal to lose. Understanding which game you are actually playing is the critical first step toward ensuring you succeed.
So, let us directly address the question you see here. We are going to carefully break down the crucial differences between the mindset of a true investor and the alluring yet dangerous trap of a speculator.
To begin, it is essential to be clear about one thing. You can invest or speculate in absolutely any asset, whether it is a blue-chip stock, a government bond, or a new digital token. The distinction is not found in the asset itself. It is found entirely in the mindset and behavior of the person who is buying it.
An investor purchases a fractional ownership in a business, fully expecting to profit as that underlying business generates cash and increases in value. A speculator, on the other hand, just buys a trading instrument, hoping only to sell it to somebody else for a higher price, regardless of the company's actual success or failure.
There is an old story that gets right to the heart of what speculation really is, and it begins, funnily enough, with a simple can of sardines.
This parable reveals the speculator's trap in its purest form. People become so absorbed in the excitement of buying and selling that they forget to ask the most fundamental question: what is this asset actually worth? They are not trading the asset, they are only trading the price.
When this kind of behavior takes over, the market ceases to be about intrinsic value, and instead becomes what is commonly known as the greater fool game. The only objective in this game is to sell your overvalued asset to someone even more foolish than you were for buying it.
Yet, this is not a sustainable strategy. Eventually, the music always stops. The supply of greater fools runs out, and whoever is left holding the asset when the price collapses becomes, by definition, the greatest fool of all.
Financial history is filled with cautionary tales. In the early 1980s, Winchester disk drive companies became a speculative mania. Their market valuations climbed into the billions, a figure completely disconnected from their underlying business fundamentals. They were trading sardines, and when the bubble inevitably burst, almost $4 billion of market value simply evaporated.
We saw it happen again in 1989 with the Spain Fund. Speculators eagerly bid its share price up to more than double the actual value of the stocks it held. Just think about that for a moment. People were willingly paying $2 for $1 worth of assets. That is not investing, it is a clear sign of market mania.
The antidote to this speculative madness is found in the disciplined, analytical mindset of the value investor. And there is no better explanation of this than Benjamin Graham's famous allegory of a character he called Mr. Market. Graham personified the entire stock market as a very moody business partner. Every single day, Mr. Market shows up and offers to either buy your shares or sell you his. Some days he is euphoric and quotes incredibly high prices. On other days, he is deeply pessimistic and quotes absurdly low ones.
The intelligent investor completely ignores Mr. Market's emotional swings. Instead, you can use his manic-depressive behavior as an opportunity. You buy from him when he is panicking and offering wonderful bargains, and you consider selling to him when he is euphoric and offering to overpay. You never take his cues, you only exploit his mistakes.
Now, if you are an income investor, this is a point where you must pay very close attention. The relentless search for higher yields can itself be a dangerous trap, one that can turn a prudent investor into an unwitting speculator.
This intense chase for yield can make one vulnerable. Investors get lured in by complex financial products that promise high returns, but these products often contain a hidden and costly catch.
Let's take a Ginnie Mae fund, for example. The high cash distribution you receive from it is not all profit. A significant portion of that payment is often just your own original principal being handed back to you. If you spend the entire distribution, it's the financial equivalent of withdrawing money from your own savings account and calling it income. You are simply consuming your capital. Option income funds employ a similar sleight of hand. They generate income by selling away the potential for future gains on their stocks. This means that when the market rises, your upside is capped, but when the market falls, you are fully exposed to the losses. It's a structure that can lead to a slow but steady erosion of your principal, all disguised as an attractive high yield. Ultimately, achieving long-term success in the market is not about discovering a secret formula or acting on a hot tip.
It is about cultivating the proper unemotional temperament of a true investor.
The successful investor is rational and patient, using the market's own greed and fear as a source of opportunity. The unsuccessful investor, in contrast, is controlled by those very same emotions, buying high with the euphoric crowd and selling low in a state of panic.
This is the one question you must ask yourself before every single investment decision. The path you choose, whether to analyze the business or to guess the mood of the crowd, will ultimately determine your long-term financial results.
The market will always present you with two very different games to play: the investor's game of business value and the speculator's game of predicting price. The game you choose to play will define your financial future. Thank you for watching, and please click like and subscribe for more analysis to guide your journey.